hello and scream it, good morning. And it is a good morning for me. Good morning and welcome to the second hour of TheoTrade. I am Professor Jeffrey Bierman. I'm broadcasting you live from Chicago, and today is Tuesday, October 28th, 2025. We're getting close to the end of this month. I see a lot of changes in rotations, which I'm going to hit on. But in the meantime, let me lay the game plan. We're going to do part two today of perverse logic. Wall Street's nuts. Like I think a lot of these analysts, they're just lie. They call it like, it's just fake models. They just come up with anything to justify why they want something to go higher because they're agendized. So it's just an invasive critique of Wall Street's fuzzy math part two. How they come up with certain things. Then after it crashes, the funniest part is it's like people always go, "Who could have known?" If you had actually read the fine print and crunch the numbers, you would have realized it was just a house of cards. And there's also the other side, which is the bullish side. So I'm going to argue on both sides here. So we'll get to that in a minute. In the meantime, I've got 30 minutes, and we're going to get through this hell or high water. I got to do this, people. It is my duty. It is my honor. It is what I do to like poke fun at Wall Street, the little bit of Louis Rukeyser in there. So I'll say hello to the usual suspects. Kajiv, how are you? Butts, John O'Donnell, Peter Schrader, how are you? Peter, did you take any of my shorts? They all have something in common, Peter. They're all going down. Hey, Rosario, good morning. Ted, Bardeth, I think the Genesis Cog people are quite happy with their short positions because only one's not working. And even that one's coming in today. But the other six are just getting annihilated, okay? We're on to something here, people. We've decoded these algos, and this ain't going to last forever. But in the main, it's here to stay, and I'm not getting bearish just yet. In fact, I haven't been bearish on the market, period, until we break through the downside. So without further ado, we're going to talk about today's theme. Today's theme is called escape velocity. You've heard the term. You've watched the movie The Right Stuff. You've watched, Cape Canaveral and takeoffs. You've watched NASA, like black and white videos. That's where it comes from. We're going to get a little scientific today, but you're going to have to take that scientific concept and port it over to the market, okay? And I'm going to do the best I can in order to stylize it, or what I call colorize it. Stylize, colorize, heavy words to talk about. Okay, what is escape velocity? That's the first question. And how does it relate to the market technically, okay? First off, escape velocity, by definition, okay? Collins Dictionary, escape velocity is the minimum speed required for an object to break free from a celestial body's gravitational pull without any further propulsion. So escape velocity is a crucial concept in astrophysics and aerospace engineering. It represents the speed an object must reach to escape the gravitational influence of a planet, moon, or other celestial body. This speed is independent of the direction of travel, okay? Making it scalar quantity rather than a vector. So it's not, a vector means straight line. Scalar means it could move in an elliptical, it could move in a curvilinear, okay? It doesn't always have to adhere to that direct line vector, okay? Understanding escape velocity is essential for space travel as it determines the initial speed needed for a spacecraft to leave a planet's gravitational field without additional energy input. Basically, what it comes down to is how much fuel has to go into a rocket to get it up to speed, to get it outside the Earth's atmosphere, which has the gravitational pull, to keep it within the clouds rather than go above and beyond the Earth and hit into outer space. That's what it is. That's what escape velocity is, okay? And you can see the stylized depiction where with escape velocity, if it's strong enough, it can break the Earth's atmosphere. But if it doesn't have enough escape velocity, it'll stay orbiting around the Earth itself. And if the velocity itself dies altogether, gravity will take it and pull it back to Earth. Did you understand what I said? Okay, let me show you what it looks like in a chart so you can understand this better. Because if you don't understand it, I'm going to show you how it works with the S&P 500. Okay, so here's what I'm telling you. The market is not run by people. Stop. I don't want to hear it. Okay. I trade, you trade, institutions trade. But we all know it's run by algorithms because algorithms are in 24/7. People are only in for minutes at a time. They fill an order, some paper, some size, they VWAP spray, and they're done. Okay. It's the machines that are greasing the wheel and keeping the market going and keeping this absurd momentum all the time. But think about this. The Earth's gravitational pull, the way I perceive it, is simply this line, the overbought line. Now I'm keying off a quote unquote, oh my God, the short I just took a short on knee. It's getting killed. Blake, I got short knee. Sorry, took it at 85. All right, no, it's just getting whacked. All right, so what I'm telling you is that the Earth's gravitational pull, the way I see it, as it relates to the market, is the overbought, oversold. I use the weekly. The daily's worthless. The monthly is just too much of a smoothing factor. The daily's not enough of a smoothing factor. But if you look at this diagram, you begin to realize the market's not coming down. But it's coming down. No, it's not. I've told you every day for 2 months, this is unshortable. And I've been right every single day. When are you going to listen? You can't fight the gravitational pull. You can't. Now, for me, the gravitational pull should occur at the 70 threshold. It should. It might even go beyond the 70 threshold, but the 70 threshold represents the Earth's atmosphere. In order for the market to go beyond that, you're going to have panic buying, like yesterday. You're going to have technology and financials driving, like yesterday. So what you're getting is what we call in the business a pivot. It's a MACD pivot. So instead of this rolling over, which you need to correct this market, we are now pivoting upward for another leg upward. As Garrett says, 7,000's all but a done deal. It's just probably going to happen. We might need to go to 77, 78. But what I'm telling you is, even if we go beyond, because we're now in what's called escape velocity, like that ecosystem, we're in there. We're inside escape velocity. You're going to have tons and tons and tons of liquidity to make this happen. If ever there is a short circuit of liquidity and a change in psychology that abruptly starts stops or sort of like disrupts the escape velocity, God help us all. Because eventually what happens is gravitational pull pulls in. Gravitational pull simply means that the sellers who want to get out have had enough. They're going to sell. They realize that the upside is no longer there. They still have a little bit of upside. They still got another probably 300 or 400 points here. But once they realize that the configuration changes, then all of a sudden, okay, they have to keep injecting escape velocity over and over again. You have to have the rate of change of money and buying has to come in at that same pace or the market rolls over and dies. So you're now officially in escape velocity. You're outside the Earth's atmosphere. You're outside the technical boundaries of 70 on overbought. You're there, and you can see it's pulling us upward. But I keep telling you, the escape velocity, okay, once it's done, you have to maintain that rate of change. Otherwise, it will get sucked back down, and then will mean revert, and this will come back about 50% of the gain. So what you're seeing here is 4,800 to 7,000, 2,200 points. Just slice off 1,100. Just cut it right off. We're probably going to go below the 6,000, 5,800, it'll overshoot, and you'll begin to realize that the gravitational pull of mean reversion will kick in. This is what happens in the final stages of a bull market. You go outside the orbit, you're on escape velocity, you're on a 90-degree angle, you're pivoting, you're parabolic, you're chasing. But that's the final chapter. So how much escape velocity have we got left in terms of time? I don't know. But I can tell you that once this curls over, it's like the escape velocity represents all the energy bundled in one day or a week that's now been evaporated. And now all of a sudden, the sellers can take hold. The market's not going to reverse unless there's a key reversal day. And I can show you, I'm short knee. Now, I caught knee on the $3 reversal because it's a reversal, what's called engulfing. I'm an expert at this. I know how to trade these things. This is not a reverse, so you can't short this. It's not a reverse setup. You have to have the technical setup. You have to have the candlestick setup to do this. So I will alert you when there's a reversal day. but clearly we're in escape velocity that's driving this market higher, and it makes it really hard to short. But this could be the final frontier, starstruck verbiage, to get the market to top out. If you want to know what it looks like intraday, the 30-day 4-hour is the most accurate intraday indicator ever created. You can see it from my perspective. What have I always taught in the Genesis COG members? You cannot short parabolic. It doesn't work. Look how it's parabolic. Okay? You can fight me. You can spit on me. You can yell at me. I don't think I'm right. I know I'm right. You're not getting this down. You have to curl this mama. You got to curl it. If you can rip curl it underneath, you got a shot at driving this down 300 or 400 points in an hour. You got to reverse this. It's parabolic. You still have the histogram bars going up. So every dip is going to be bought. Not by you, by algorithms. They're programmed to buy this configuration. So for those of you shorting here, you got 10 bucks, head for the exits, go get wasted, hang with Tony Rego, go to the club, you're done for the day. Because if you think this is going to reverse 100, the likelihood is just not there. It can happen, but not in this type of setup. It won't happen. It doesn't matter what the advanced decline says. It's the setup of the actual MACD. That's the key to the market. Now, without further ado, I want to talk about 3 things today, even if I go over on my show, does not matter to me. First thing, pick them. So you can pick any metric you want. You can pick Tobin's Q. You can pick the Buffett indicator. You can pick price earnings multiple. You can pick PEG multiple. You can pick cash flow multiple. You can pick free cash flow to equity of the firm multiple. You can choose EBITDA multiple. You can choose any metric you want in the world. And the market's 100% overvalued. It's official. Does that mean it's going to come down? It does not. But I'm telling you right now, you can come out and you can say, well, it's overvalued on this one, but on this one, it's got room to maneuver. Not true. Every single, hypothetical academic market metric that's used in every book ever created, even by people who are not authors, are telling you this is the most expensive market ever. So if you want to go out there and buy this market, tell me to go hide in the closet and you do it yourself. Well, I just print money, like protecting myself as on the way up. Because on the way down, you're not getting out. I keep telling you, you're not. Valuation matters on the way down. It does not matter on the way up. To me, valuation always matters. But on the way down, you ain't got a prayer. Because the lower it goes and the more you buy, the more money you lose. Okay, just ask the people who stepped in and started buying some of the stocks that were oversold today. And they got more oversold with an RSI near 0. Why? Because technicals don't mean bupkis when earnings and valuation dominate. That's what you're going to learn one way or another. Your perception doesn't matter. The reality is fundamentals in the long run are going to do you in. So you've been warned. Every valuation, you're done. Next, send them down the river. Now, this is not a referendum on Amazon. I'm not picking on Amazon. In fact, Amazon, I love Amazon. I got an Amazon account. My wife's got Amazon Prime. I just ordered Amazon. I just got some cool stuff from Amazon that I needed for my garage, blah, 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 whatever. Amazon was tinkering with the idea. Tinkering. Good word, right? They put out the word yesterday that they were on the lam for cutting 30,000. What? 30,000 corporate jobs. Oh, I'm going to faint. 30? I didn't even know they had 30,000 corporate jobs. I had no idea. Scary stuff. Apparently, Amazon's got hundreds of thousands of employees, like 300,000 employees. But the executives who pay themselves 30 million said, hey, somebody else is infringing on my 30 million. I got to fire that sucker. Let's just fire 14,000 of them. So Amazon said, let's send them down the river. Pun on the word river, because Amazon's a river in South America. Get it? They're sending them down the river. They're not even furloughing them. You're fired. Get out of here. And, and take your things out. I'll have you, the joke is I'll have you arrested for trespassing. What does that tell you about this economy? Now you know why the Fed's cutting rates. The Fed's not cutting rates because inflation's coming down, because it ain't. We're heading for stagflation, and the Fed knows it. They just don't care. They're like, people will just absorb it. They'll have to suck it up. What the Fed's cutting is because they're reading the handwriting on the wall. If Amazon's cutting 14,000 jobs, holy moly, Who the hell else is next? That's telling you that thousands, hundreds of thousands of millions of people in the next 3 quarters are going to be fired. Now, whether it's an AI displacement or not, it's telling you. Amazon rallied. Oh, it's so good that we fire employees. It'll help rally the troops and buy. Yeah, it rallies the stock until it doesn't rally the stock. Oh, that's just cruelty. To think Amazon's cutting jobs and Wall Street's like, yes, you're getting fired, and I'm celebrating by buying your stock right in your face, man. Yeah, because it's going to lift margins, right? This is telling you one thing. I'm warning you again. The market ain't going to stay here, because when you start laying off people, there goes the neighborhood, people, because 2/3 of the economy, 70% is what? It's consumer purchases. And if you've got corporate executives being laid off, you just lost, and just not just Amazon. This is going to metastasize. If Amazon's firing, everybody's firing, okay? You're going to see layoffs at Microsoft, layoffs at Meta. It's coming. What a Christmas it's going to be for people who aren't going to buy what? They're not going to buy Christmas presents because they're going to be laid off. People, something bad's happening here. And what's bad is happening here is the economy, even though the GDP is holding up, the workforce is shrinking. And if the workforce is shrinking, it means that machines are basically holding the market up, not people anymore. And if people are not going to go out and spend, what's that going to say for the economy in terms of the GDP and spending and production? It's going to be interesting. Third here is high as a kite. I didn't quite get this correct. I'm going to have to move this over. So Citigroup comes out every few months, and they come out with this index. It's called the Lefkowitz Index. And it's like Tobias Lefkowitz, who is this quant genius. And he is. I'm not disparaging him. I'm not making fun of him. He really is. There's like one in each firm. Marco Kalakanik at this firm. Every firm's got a quant geek who like heads up all of it. Like just complete PhD freak number people who come up with these like really esoteric black box models and say this stuff. So Citigroup's Lefkowitz model is an index of market sentiment. So here is what Lefkowitz's model showed at Citigroup as of yesterday, and it was published nationwide. It's called positioning euphoria. What the hell does that mean? What's positioning euphoria? Interesting stuff, people. Interesting stuff what it means. So what positioning euphoria simply means is, and I was shocked is, positioning euphoria is a term, okay, where according to the U.S. Equity Strategy Group at Scott Cronert, who works with Tobias and team of strategists, they met with clients in the U.S. and Australia to gauge sentiment. They said they were impressed by nagging concerns over valuation. Oh, of course, there's a valuation issue. Possible artificial intelligence bubbles, credit and macroeconomic factors such as the state of the job market worries them. But according to them, they said, and yet with all these worries, okay, they met with clients. They found that investors are sticking to high levels of U.S. large cap equities in their portfolios, which means we know about all the risks. We just don't care. That's what they're saying. And Citigroup's Lefkowitz index shows, quote, its highest level since outside of the 1999 tech bubble. So 26 years ago, you had this euphoric index peak, and it's now back there. That's when crashes occur. Basically, it peaked right before the 1999 tech bubble and the post-pandemic recovery trading. Okay, euphoria comes as investors can't shake the unease over the current bull market and various bubble concerns. But because of the need to be in rather than be out, they're holding their positioning and not hedging. This contrast suggests many are bulls in the current market, acknowledging the tech bubble and the global financial crisis influencing their mindset. But yet at the same time, they know about the wall of worry, but they do think that the news will incrementally get better rather than be disappointing. So they think they're ultra bullish, they're fully invested, they own all these bubble stocks, and they refuse to get out because they think that the market is so worried about them and it's so out there in the news that it's priced in. So get this. They think that the worry is priced in. That's what they're saying. The worry is priced in? No, the euphoria is priced in. So their positioned euphoria tells them They should be selling, but they won't be selling because they think things are going to get better and the bad news is priced in. That's how screwed up and perverse the market is now. People aren't selling, which is why it's not going down. And they're letting the algorithms continue to run the market straight up amok and keep buying the market. That's why we keep going up. Lack of selling, algorithmic buying. These are scary times, people. You better think about this because once people start selling, and it may be too late, and algorithms take over, it's going to be no prisoners taken. Now, individual stock stories. I got about 10 minutes to get through this. One of the stock stories is, I can't believe Don missed this. And Garrett missed it. Garrett Baldwin, you missed it. FFIV. F5 Networks, as it used to be called, okay, came out. And I titled the story called Back to Normal. Let me lay this on you, people, because this stock completely is now down about $80 in about a week, okay? It's too late to short the trade. This is not even a trade, okay? Company reports 439, they beat the estimate. So now you're thinking to yourself, how the hell could this stock blow up and be down 8% today when they blew out their estimate? Okay, this is a warning to all of you. There is always an idiom, a narrative that destroys stocks. Let me lay the narrative. It's one sentence. If Microsoft says it, if Meta says it, the market's going to crash. No doubt about it. The word is normalize. What they said was our growth period is going to normalize. That is the kiss of death in technology. If there's anything I've learned in 38 years, people say a picture, a picture paints 1,000 words. One sentence can crash a market. One sentence. That one sentence that blew that out, we're going to normalize our growth trajectory. If any tech stock says that, you're dead, you're not getting out, and you can't hedge it. If you didn't hedge this or sell this and you work for me, you'd be fired. I wouldn't give you, I don't even care what you say. I don't want to hear it, okay? The stock is just ripping upward. It trades not at a bubble level, but you have to understand, like Garrett Baldwin says, the purpose of every market is to sell. It's not to buy, it's not to hold, it's to sell. I went out, I bought Gap, I made $4, I sold it. I went out, I bought Target, I made $9 in a week, I sold it. That's what we do at Genesis Cog. We make money, we buy it, we get out, we buy it, we get out. We don't give back gains. This is people giving back 6 months of gains, which is unconscionably, that's just unthinkable if you work for me. You cannot give back gains. You buy a loser and lose money, I'm okay with it. You buy a stock that's a winner and give it back, you could just clean out your desk, you're fired. I don't even want to hear what you say. You cannot give back gains like this. This is a referendum. When a stock says we're normalizing growth, watch that stock crash and burn. You never want to hear that because all these tech stocks are primed for what's called accelerated growth. And when you say normalized, that's telling you growth is gone. Beware, you've been warned. Okay, next on the list today. Next on my list of stocks to cover. Garrett hit it earlier. I'm the one who picked this off first. I call it payoff buddy. I'm not saying anything other than this, okay? The Genesis Cog owned this stock. We did. We bought it at 68. We sold it. We bought it at 68. We sold it at 75. We made $8. We bought it here. We bought it here. We sold it there. That's what we did. Then we bought it back here and we sold it there. I just traded back and forth. But we never trade ahead of earnings. Their earnings were spectacular. They were great. So the stock opened up, okay? And I wouldn't short it, but it opened up in pre-market, and this is what threw me. Somebody panicked and crapped the bed and had to change their underwear and take a shower and clean off those skid marks and bought it at 82. Why the panic? Why the panic? Never trade on the opening rotations. Let it play, let it come in, buy it. You could have stepped in and bought it at 73. Calm down. Every stock will come down eventually. Even the ones that run away come back in. So here, this is a nice, look at the money going in. Stock is totally unshortable. That stock's going higher. How can you tell? Because the money flow never lies. Your eyes deceive you. People, you should be buying PayPal. I said 5 months ago on Theo, I told every one of you that on the Genesis Cog, this is the cheapest financial stock out there. I told you, okay? The PE on this thing is now down to about 14 after reporting today. This is a stock I want to own. I just don't chase it. I will find an entry point. I will get in. This is a bad short, but I kept telling you, valuation matters. This is a bad short. Don't short this. A multiple that low with a stock with earnings like that, that is not a good short. The multiple could expand and blow you out. I like the fact that there's massive money flowing into it. That tells me I really want to own this sucker and I want to own a lot of it. I just don't trade ahead of earnings. I got out at 75, 76 because they could have blown this out. It just so happened the earnings were good. We don't tempt fate. We just don't do that where I preach. We don't. Cruise Brews. So RCL blew up today. Finally, RCL blew up, Garrett, down to 9%. Okay. I don't want to go any further except to tell you this. Every single stock goes through a day of reckoning. So for all of you out there who are like telling me, Bierman, you missed Palantir. Oh, who cares? I don't care. I make money. Making money is all I want to do. I don't care how much I make. Just keep making. That's all I do. Okay. I'm not looking for 100% return. I'm looking for 20% year in and year out. If I make that with low risk, I've done my job. Because it takes one day to get something like this and your career is over. Okay. What this is telling me is this. It's not that things are bad. Not bad at Royal Caribbean. What the market's telling you is their earnings have peaked. The economy's topped. The consumer is tapped out. Amazon's laying off jobs. The same day Amazon lays off corporate jobs, RCO crashes and burns. It's not a coincidence. People, listen to the market. The market talks to you every day, as Gianni says. Listen to it. It's telling you that the consumer is tapped out. Okay. It's not, the stock's not going to crash. It's just the stock's not cheap. And at this point, consumers are going to fly less, travel less, and spend less. And this is one of those discretionary trades where you could basically get out of this, okay, and move on. 21 is not a bubble. It's not. But this could compress to a 15 or 10 multiple because the economy's slowing. Watch the layoffs, okay? Watch the behavior of consumer discretionary stocks like this. This is what we call a wealth effect stock. When the wealth effect stocks top, it tends to indicate the economy's topped and the market's topped. The only thing that's keeping up this market is technology. It's not financials. It's not industrials. Technology is lifting the market. It's AI. Take out the AI story and the market's probably at 4,000. AI is responsible for 3,000 points of this, people. That's what it is. Last but not least, okay? Brown means green. Isn't that terrible? Isn't that disgusting? Am I disgusting? Brown means green. Now, everybody people are thinking underwear. No, brown is the nickname for what? UPS. So UPS came in and they basically, oh my God, they're just killing that knee. That's awesome. So UPS came in and they were up 6. But here's the interesting thing about this. Somebody in the pre-market, okay, basically wet himself or herself and paid 109. Calm down. Look at that. And they sold into it. Notice how the stock is up 7, but the money is flowing out of the stock. Did you notice that? That's why you come to me, okay? I'm not buying it, okay? I know they're way better than expected, okay? And you're thinking Christmas. It doesn't matter to me. I don't like the fact that even though the stock's running, and I won't short vertical, do not short vertical. This will not work because the parabolic MACD won't work. But if this tops out and curls and rolls over, it might just go right back to 80. What this is telling you is it could be a one-day wonder. Be careful. Money flow is everything. Notice the money flow is out of UPS. What the market's telling you is, over the long run, they do not believe that the delivery of goods and services from this particular logistical carrier is going to sustain. Trust the money flow. Don't trust the chart. The chart lies all the time. This money flow tells me this could be a one-off. You might see the mean revert all the way back to 90 and sit at 90 bucks a share. Impressive earnings because it's green, but the money flow worries me. That's what I'm telling you. Don't go chasing this. I won't short it because I'm smart enough not to short it. It's a violation of the model. But I ain't going to buy it either, people. Why the hell would I buy something like this? Why would I do that? That's not smart. Okay, you don't want to, it's over. It's already run its course. You need for it to come in where the risk is not there. Now, ultimately, we're going to go back and we're going to talk about, okay, fundamentals. I want to do fundamentals today, whether you like it or not. Even if I have to amuse myself, I'll do it. I want to get somebody to listen, but not everybody will listen. We're going to do fundamentals, and we're going to do Lilly and pins today. I mentioned yesterday in sort of like in no uncertain terms, right, that the market is made up of perverse logic. Gianni says it all the time. The market's illogical. Blake says it. Brandon, every one of the instructors say the market's full of it. It is. It's illogical. Just go with the technicals. I love technicals. I do. I use them as entry points. I use them as exit points. I use it to evaluate trend, momentum. Oh, hell, I use it all the time to like volatility map. But technicals don't tell the story. What tells the story are the fundamentals. And Wall Street, for the last 25 years, has this terrible habit of making up fuzzy crap, ridiculous math numbers and upgrading when it's obscene and downgrading when it's even more stupid. Like the analysts, I'm panicked. We're going to downgrade the home builders, and then they rally 100%. Schmuck. Why? Why are you downgrading it at 4 times earnings? That's a low. It's not going any lower. They bottom out at 4 and they max out at 12. What, you haven't been in business long enough? Learn the business. Fundamentals matter. They just don't matter in the short term. They matter in the long term. And they don't matter on the way up. They matter on the way down. You learn this. I'm going to walk you through Dash. Not Dash, pardon. I did Dash yesterday. Eli Lilly. Now, I got nothing against Lilly. They're headquartered in Indianapolis. They're an amazing company. They're an absolutely amazing company. They have a suite of not hundreds, but thousands of products that people use. They're life-saving. This is not a moratorium or referendum against Lilly. This is an unbelievable company. But the fact of the matter is this company's been overpriced for so long. It's a wonder to me why people keep piling in here and keep piling out of Bristol Myers and piling out of Merck. And it's simple to me because most money managers just key off of charts. They look at the chart and go, grunt like a simian ape. Chart, good, me buy. That's what they do. But they don't dig into the numbers. Some do, most probably don't because they don't want the headache. They just go with what the analysts say. And the analysts, of course, usually key off the charts. Again, I'm not picking on Lilly as a company. I'm just saying, how do you know how to value something like this? The last 5 years have been stupidly wonky. Now, if you're looking at Eli Lilly, okay, recognize that you can't know all the suite of products. It's impossible. They're in the pharma space. I mean, it's just insane. Look at this. Arthritis, spondylitis, okay, axial spondyloarthritis, musculoskeletal pain, elbow glyphs for atopic dermatitis. Okay, they do everything. They're the everything. They're the Walmart of pharma. They have 1 billion products. Okay, I get it. But the fact of the matter is, numbers don't lie, people do. It's a fact. So you've got various analysts, some who are like, avoid this. Here's Schwab says avoid. Morningstar's got neutral. Then you got get on it. And then Argus is like, you have to buy this. And then LSEG says it's an outperform. Whatever. Okay, whatever. Dig into the numbers and see what it's really worth. What I find interesting about this is when you look over the years, okay, most of Lilly's numbers, is because of the wave of weight loss. The weight loss narrative is akin to the AI narrative. It just starts hitting every social media site and everybody just goes gangbusters and says, well, nothing really matters except us playing homage to, okay, this Ozempic, because that's what they do, or whatever. What was the other one? There's like Wegovy. It's one of the other that they do. And it's like, okay, so they're really into that. But they do more than that. But that's their blockbuster driving product. So I went down and just added up the numbers, just the last 4 numbers. 334, 532, 118, right? And then they've got what, 392? I add all these up and I get somewhere around 12 bucks. $12, right? A share. So when I divide $12 a share into this, I get a stock trading at around 70 times earnings. 70. Now, I've been around a long time on Wall Street. I'm not by any stretch of the imagination an expert in pharma. My expertise for analysts for 30 years was transportation, it was retail, and it was small cap semiconductors. That's what I did. And I'm also an expert at what's called storage REITs. So I specialized in certain areas that I was assigned. I knew what to do. I knew how to price them. I knew how to read the financials. I understood the business models. This one's a little bit above my pay grade. But I do know one thing. There isn't a pharma company in the world that's ever going to grow at 70% that's as big as this company. Eli Lilly is one of the 50 largest companies on the planet. Go look it up yourself. Their market cap is insane. It's not nearly as Apple. It's not there with NVIDIA. It's not in the trillions, like up there in the 4 trillions, but it's up there. Okay. So this company has gotten what we call like, an asterisk. It's gotten like a get out of jail free card for whatever it does. And when I look at the comps of what they've done, and I can look at this, day after day after day, and I can look over 2 years and go look how much have they made. And it's like here going backwards from where it was here. Okay, they're reporting coming up, but here's 631, and where that came, and over here it was 892 or 392. So it went up. But the law of large numbers dictates that the larger the company gets, the rate of change of growth normalizes. So you're in this period where you have a breakout, which they call, massive growth, and you go into consolidation, then you go into maturity and into decline. Clearly, Pfizer's at the phase where it's between maturity and decline, which is why it struggles to move. And it's like a PE of 8, so it's cheap, but it can't get anything behind it because you have to have a blockbuster drug to lift that growth multiple. This stock is a great company, but it says 53.7. It's more like the Lords of 70. But at some point, it has to realign with its peers. So if you go through its peers in comparative analysis, that's the best approach. So if you know nothing about this company, all you would need to do is go look at its peers. So here's Merck, 13. Here's Pfizer, 13. Here's AstraZeneca, 31. Even that's expensive. Historically, pharma companies that have been around beyond 50 years, Pfizer, Lilly, Merck, they've been around more than 50 years. They're not a newcomer. They're not a biotech. They're not an IPO. They're not fresh off the boat. Okay, they've been around. Historically, the multiples on these, going back decades from the books that I used to read, somewhere between a multiple of 8 to 20. 20 on the high side, which means they've got a lot of things in the hopper. They got clinical phase trial 3s coming out. They're ready to release them, get one approval, and there's $1 billion. Got it. But I'm not picking on AstraZeneca. I'm not picking on these other stocks. I'm just trying to tell you. You go through, here's Abbott Labs at 16. Abbott Labs is about 45 minutes north of me here in Chicago. 2 of the students who used to work for me, 3 actually, now work for Abbott Labs. I helped write a letter of recognition for one of them. He's a bright kid from DePaul. He's now trying to pivot into a hedge fund because he knows a lot about Abbott Labs products and wants to be an analyst. Good for him. Bottom line is this, okay? These stocks at 16 to 13, they're just not expensive. So if you say, I'm going to short them, not a good idea. Not a good idea because there is a floor value in these stocks. And the floor value tends to be around, in a bull market like this, a floor value tends to be 13 to 16. I'm not saying this can't go lower. I'm just telling you, that ain't a bubble. It's not a bubble. Neither is Pfizer. Neither is AstraZeneca. Bristol Myers, it's down to about 15 times earnings. That ain't a bubble either. None of these are bubbles. None of them. But the charts look like crap. The only one that looks good is the Lilly chart. Why? Because when analysts and hedge funds go out to buy stocks, okay, they come out and they're looking for the highest multiple, because the highest multiple implies the highest growth rate, implies the highest upward potential for the stock. So what they're doing is they're discounting any historical data and saying historical data doesn't matter. Just key off the multiple. That implies a 53% growth rate. The number actually should be 70. A 70% growth rate, I'm going to buy it. Risk doesn't matter. All that matters is the multiple. And if they disappoint and it crashes, here's what they say. Not my money, it's your money. I managed it. I blew out. We'll just sell. $45 move coming right at you. You can see that right there. Expected move $45. It's about a 5% move coming out here. Okay. I don't know what the numbers are. I wouldn't step in front of this. I'm just telling you, you look at stocks over years. Look at Lilly's chart. Really? I want you to look at that. Really? Go look at every other player out there. Novo Nordisk blew up. Okay. Why? Because it's a bubble. Okay. See how it blew up? Because it's a bubble. That's what bubbles look like. Do you own Nvidia? Sell it. Do you own Palantir? Sell it. Send me a love letter in 2 years. Those are bubble moves. This is what our market's doing. It's going to blow up eventually, regardless, Garrett, of that liquidity. I'm just telling you, you go through, okay, normalized. It's not a bubble, but it's getting there, okay? But its valuation's reasonable at 16, right? Abbott Labs peaked, still sitting around a high, okay? But the valuation is justified. I'm just telling you, Lilly to me is pure fuzzy math. Pure fuzzy math. How does a stock go from 2021 when it doesn't even have a product for COVID? Pfizer had it, Moderna had it. Those were the two leaders in it, and that's why their stocks popped during the COVID years. How does this stock go up other than it's got weight loss, some weight loss drugs and some peripheral stuff? Okay. That's what liquidity and that's what fuzzy math does. This stock kept getting upgrade after upgrade after upgrade. I don't know where this is going to go day to day, but I can tell you this. If you just draw a line across here, don't be surprised in 3 years, stock's a $400 stock. Not a bad company, just fuzzy math. It's just not aligned with its co-conspirators. It's not aligned with its other players. Most pharma trade between a multiple of 8 to 10 up to 20. I've been doing this for 38 years. I had pharma in my portfolios and I ran my hedge fund. I would never chase. It was a biotech. You put an asterisk because that's a young biotech where the multiple could be 100. But not a company of this size, of this age, of this caliber should not be priced like this. You've been warned. The next one I want to throw out today. The next one. Oh, I'm just looking through here. I'm sorry. My shorts are just absolutely cleaning up today. It's just one of those days where I'm short Walmart, I'm short Unilever, everything that I'm short's going down. And that's all I could ask for. Okay. The other one I wanted to cover today through the end of this week is pins. Pins. Pinterest. Now, I am not a hater of this company. Okay. I'm just telling you, there are things in life I can't do without. For example, okay, I'm not a smoker, but I could see how people who are addicted to cigarettes need Altria around. Got it. Okay. I'm not a person who I need food. So I got to have, restaurants and food to buy at the store around. So there's got to be products I need to buy. So I'm okay with that. There are certain things that you need to have every day. I need water. I need gas in the tank of my car. Okay. For me, okay, I need Google because I use it like endlessly all day long for search and the Copilot. Okay. They're indispensable to my life. If you took Pinterest and you bankrupted them, I wouldn't shed a tear. I wouldn't say, oh, there's a horrible loss. Or Peloton, oh, I could care less. They're not integral. Like Nvidia is integral. Microsoft's integral because it runs my operating system and all my I got 3 laptops. I need Microsoft desperately. Okay, I know the things that I need. Okay, I've got a lot of technology in this room. I don't need Pinterest. I understand what they are, but they're like a poor man's crappy form of Meta is what they are. In Meta, in terms of curating and trying to stimulate people's interest and using like data that they've harvested through maybe bundling through Amazon Web Services to create a dopamine in your brain to get you to shop. I understand what they're after. But regardless, for me, the most important thing is this. It has to make sense by number, and it has to make sense by demand, and it has to be like at a point where it has to be indispensable. Number one, this company's not indispensable. So if you came into Pinterest and bought it at 89 and you got blown out, I wouldn't say that's horrible. I'd say shame on you for paying $89 a share when the company was clearly, okay, losing tons of money. I mean, you go back in time and you look at what the company was doing, okay, they're losing money. There's 32 cents, here's 10, here's 1, okay? All they're doing is losing money. Well, duh, I could have told you that, and I knew nothing about the model. Their competition is fierce. They have to position themselves against hundreds of other social media website vendors who want to get you to come in and look at this advertising board, as it were. So if you don't know what it is, here's what Pinterest is. It combines the word pin and interest. Yesterday, I'm driving home. My daughter, I give her her iPhone because she's like, Dad, where's my iPhone? And then she logs in. I go, what the hell is that? She's like, that's Pinterest. And I said, when did you start logging into Pinterest? She's like, I'm a 12-year-old girl, Dad. I'm going to be 13 soon. I got to start looking how to dress the part and play the part and got my hair. She's obsessed with her hair. She wants to be a trichologist and run a hair company and be an entrepreneur. She literally, every time we go to the store, my daughter runs down to the shampoo aisle, CVS, Target, Costco. It doesn't matter where we go. It's like, I've got to go to the aisle. She pulls out the hair care products and she tells me she knows all the scientific stuff. She's like, this is the producer here. This is where they met. My daughter's a genius when it comes to hair care products. If only she could apply that genius into her math, we'd have ourselves the next Einstein. I get her into Harvard tomorrow. It's her only weak spot is her math, but everything else she's straight A's. So I digress. Pinterest, visual search, discovery platform, Europe, US, international. They basically put together ideas, recipes, home and style inspiration, search, save, shop ideas. They just curate it. They then send it out to different, they could send it out to something like YouTube, TikTok, whatever, okay? The company was called Cold Brew Labs. I have no idea why. It was incorporated in San Francisco. It's basically comes down to one thing, okay? This is an advertiser. It's just an advertising company. So what they're doing is they're charging other companies and saying, look, your advertising is generalized. What we do is we specialize it. We'll take it, we'll colorize it, we'll specialize it, we'll customize it, we'll mix and match things, and we'll get people to be driving to your website to buy more of your product and your service. That's all they are. So they don't really produce anything. They don't. All they do is they're a middleman or a middlewoman, politically correct, who stands between the public consumer spending like me and you and the companies themselves who manufacture the product or offer the service. And they stand in between and they're like an advertising medium that makes it cool and edgy. Okay, that's what they do. But here's the thing, okay, financially. They have 670 million shares. I have no friggin' idea how they came up with that. I don't no idea. The beta is less than 1. So it's not a high risk stock. And it shouldn't be a high risk stock because their business model conceptually mimics Meta, but they're not a Meta because Meta is much more, it goes in a different direction. Has a different kind of outreach. But the number's 948. So let me run the math. It says 1245 is the PE ratio. Let's actually check the numbers for it to make sure. So I walk over to Pins and I look at what they've done. And I want to look over the last 4 quarters. They are in 33 cents. They are in 23 cents. They are in 56 cents. So I'm now looking at them earning about $1, right? And they've earned 40 cents. So they've earned about $1.50. You divide $1.50 into 34, you get about a 20 multiple, maybe a 22 multiple. So technically speaking, don't trust that number. Don't trust that number at all. At all. Okay? It's about twice that number. Would I call that a bubble? I would not. I would not. But the thing is, this company has to grow at a 22% or maybe 15% multiple, at minimum 12%, to drive its stock higher. So what I see in this stock is a prisoner to advertising budgets by large companies. And on the other hand, it's a prisoner to the economic backdrop of people's spending habits. So no matter how much you put it out there and people don't spend, the B2Bs, the companies are just going to cut the spending advertising out. So this stock has what I call lumpy earnings. It's just lumpy earnings. It's up, it's down, it's lumpy. But for the life of me, when I look at this and I go through the numbers, here's one analyst who loves it. Here's an analyst who says it's a piece of crap, avoid this. Schwab says Fundamentally, it's a D equity rating. Okay. I just want to take you through here. Okay. The margins are excellent. They're 50%. Clearly, that is an absolute winner here. And they have very little long-term debt, and they're sitting on a lot of cash. That's the one thing I can say that's good about this. Decent margins, okay, decent margins, okay, decent current ratio, okay, everything looks good financially. But the one thing that throws me is this. The price to cash flow is 21. That implication is when you have a price to cash flow of 21, that this company can drive 22% cash flow year on year to this business. And what I'm telling you is, if this were something that it was an indispensable thing, like a Google, like a Walmart or a Costco, that is possible. But the fuzzy math here is that the price to cash flow is extraordinarily high. The price to earnings, like I said, is not aligned. It's actually 22. So now you're looking at the price to cash flow and the price to earnings aligned together at 20% growth. If the consumer is not spending, and you saw what happened to Royal Caribbean today, you see Costco coming in, you see Walmart coming in, which I'm short. I'm banking, like Blake, that the consumer is spending less and going to cut back. And if they're going to cut back on their spending, that's going to force companies who advertise with Pinterest to cut back on their spending. So the stock's down a little bit today, but a return on equity of 48%, because they're a service company, not if they're a manufacturing, a 3 would be just a killer. It's terrible. But I defer to a 48%. The question is that sustainable? That's the question. They had a 102% jump from one year to the next. That's during a bull market when the economy, employment is at full throttle. That's in a bull market when inflation is under control. Inflation is no longer under control. The job market ain't what it was, right? People are being displaced all over the place, hundreds of thousands of jobs every month because of AI. So it's a different world than when it was. So I'm not knocking pins and saying it's a poorly managed company. I'm just saying that the numbers themselves over the long term don't add up. And if this company normalizes, just normalizes, it will become kind of like the Goodyear tire and rubber. It'll be out there, but the growth periods will be lumpy. The growth periods will be a function simply of the economic backdrop. When there's a spurt in the economy and people are rich and being hired again, then Pinterest will pick up. And when the economy is contracting, when it's peaking, when it's expensive, when there might be stagflation, okay, it puts and weighs it down. You can clearly see the stock itself has hit some form of a sort of a headwind here. Okay. Every time this stock goes up, I just go out to short it. I just don't care. If it goes to 40, I'll short it. I shorted some of it at 39. I wrote it back down to about 34. I will short it. I'm not going to short it here because it's not overbought enough. I just want to see it go back up so I can short it. To me, if this stock ever gets below that 28 threshold, that could really leave money managers who own a position in this in a terrible situation. Because again, this is not a necessity. It is a luxury. If you're going to own a luxury, it needs to be in certain areas like Ferrari, or it needs to be in Blue Nile. It's got to be in Tiffany, something where the rich, they ain't like you and me, like in F. Scott Fitzgerald's. Like they're just not there. The rich don't care about how market does. They'll just spend because how many Ferraris is irrelevant. But when it comes to the average Joe in America who looks at Pinterest, a millennial, Generation Z, they just got their first job, they just graduated college, okay? This appeals as long as they got a job and there's a good job market. The job market, it sucks. It just sucks. It's not good. There's not a lot of jobs out there. People are struggling to find jobs out there because companies are cutting back. They're substituting AI. There's a lot of changes going in the economy for efficiency purposes and whatnot. So I don't think the company's going to go bankrupt. But what I'm saying to you is this is not a stable company. It's a cyclical company. Caterpillar is cyclical. Deere is cyclical. This is cyclical. Home builders are cyclical. Price this like a cyclical. And when cyclicals are priced, okay, be aware that even there might be a higher multiple for higher growth rate, If they disappoint, they crush these things. They just crush them. I don't see this as a cheap stock yet because it's a 22 PE and a 22 cash flow. But maybe if it gets down here low enough, it might become a buyout candidate for somebody who might like integrate it. Who knows? Omnicom, who knows? Could be Meta finds them interesting. But at this point, to me, this is just pure fuzzy math. If you're going out to buy this, thinking that this company is going to change the world, they had one good quarter, one, 56 cents. But if you go through the quarters, here's what, 23 cents? It's an improvement over what they did. But the fact of the matter is, you look over here, it went from 53 cents here back to 23. Great quarter, average quarter, good quarter, average quarter. In other words, they're just rolling with sentiment. They're rolling with cyclicality. They're rolling with the consumer. The only way I think math makes sense in this is not to invest in this in the long term. This is not a long-term investment. It's a trade. If you're going to trade it, you buy it when it's oversold, when it's ripe for a buyout, when it's ripe where the economy's kind of bottomed out, where you think what the market's taking a hit and the valuations come in, and then you go for a dead cat bounce. But to me, the math of this just does not add up for a long-term growth. It's not a great short. I think Lilly's a good short longer term, but around earnings, I don't short. But hear me out. I just don't believe Pinterest is positioning itself to be like a disruptor. They're not a disruptor. Tesla was a disruptor. They changed the entire world and flipped the world on its side and said electricity for all cars. Bam, that's a disruptor. Okay. Mark Benioff, Salesforce.com, disruptor. CrowdStrike, cybersecurity, disruptor. They changed the face of the world and the way we operate. This ain't changing the face of the world we operate. This is just like rearranging the deck chairs on the Titanic. It's interesting. The musicians are still playing, but the upside of this stock, to me, if it goes up, short the hell out of it. If it goes down, okay, you can buy it. But the math in this thing does not equate to what I consider to be a bargain at all. On that note, I'm going to turn this over to Gianni DePoci. I'm going to spend the week here, like, giving you my picks and whatnot. Wow, that is really nasty on knee. And I'm going to let kind of Gianni run with this. I will do part 3 tomorrow, but just as it were, okay? And I'll tell this Gianni. And again, I keep telling you, I'm making the bulk of my gains, Gianni, on the short side. I've been telling you this all week. I'm the guy who shorted Walmart. Nobody wanted to touch it. I'm the guy who walked in, shorted Southern Company at 99 SO. It's just walking it down. Okay. I'm the guy who just shorted Unilever just a couple of days ago. We're on to something here. And all I'm telling you is that if you're only playing the long side of this market, you are missing so much opportunity on the short side. We just got short knee today at 85.5. Take a look at NEE, Gianni. Look at that one. There's blowing that sucker out the window. See that?
Oh, yeah.
So again, Gianni, we have a formula, just like you have a formula at Trinity. Okay, I have a formula for shorting and longing, and the formula is simple: lowest risk at the highest possible return. Read the algo order flow and just go for it. Stop thinking. And this is only, it only works in a short-term window, Gianni. It doesn't work long-term. In the long-term, Gianni, it's fundamentals. That's how it works. That people are like, why is the market going up? Because people are going to make a lot of money with AI. That's why.
Yeah.
Okay. But in the short term, I think like if the technicals are going to drive this market where it's going to go, not the long term. But I do think the market's on borrowed time here, Gianni. I do think we're getting closer to a top, but it might not be until later November, December at this point. We might get a correction of 5%, but I do think it's possible we get to 7,000, that round number, before we come in. I do think that's possible.
Oh, we're not far from that now. Only, 90 points from that now.
Yeah, it's not really that far away. But again, I'm not willing to short this because it violates everything, which means that it violates my model, and I just don't short on the way up.
Sure.
I just short on the way
That's
down
key.
because I don't want to fight the machines. Because Gianni, if they come out with Trump has a tweet, well, we could be up 100 points in about 10 minutes. You got to be careful.
Yeah, and who knows what Powell has up his sleeve tomorrow? And plus, you have the Trump Xi meeting on Thursday, so that's it's gonna be key.
It's definitely going to be key. Anyways, I'll turn this over to you. Have a great day. See you.
Thanks, Prof. Same to you. All right, what's going on, TheoTraders? How's everyone doing today? I hope you are doing well. I hope you're feeling good. I hope that you are long to some extent. We actually booked gains